Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on everything that you need to know at 3 p.m. Eastern Time. Facing the fire, the first of two hearings this week over the collapse of Silicon Valley Bank and Signature Bank. Three regulators facing questions from Senate Banking Committee members today. We will hear from Republican Senator Cynthia Lummis.
Plus, Alibaba is breaking up. Don't be sad, though. This is good news, as you can see. The e-commerce giant announcing its $220 billion empire will be divided into 6 main units. The move comes a day after the company's founder, Jack Ma, resurfaced in China after months of absence.
And later, we've got some big earnings reports after the bell. We'll bring you the numbers from Lululemon and chip giant Micron as soon as they cross.
But first, let's get you up to speed on the latest out of the banking crisis. Top banking regulators testifying today in the Senate over their department's role in the collapse of Silicon Valley Bank and the fallout from it. Yahoo Finance's Jen Schomburger has the details for us. Jen, certainly was an interesting day. What did we learn?
Hey there, Dave. In an at times fiery hearing, lawmakers on the Senate Banking Committee on both sides of the aisle grilled 3 regulators on why Silicon Valley Bank failed. Ranking member Tim Scott called it a classic tale of negligence, while Senator Tester said that I'm a dirt farmer, and I'm going to tell you that I didn't need to be an accountant to figure out what the heck was going on here. Barr said to that he agreed. Tester implored Barr to look back at what transpired and fix it. He says if it's the regulator's fault, it better be fixed. The Federal Reserve's Vice Chair of Supervision, Michael Barr, along with FDIC head Martin Grunberg and Treasury Undersecretary for Domestic Finance Nellie Lang, all pledged to strengthen capital rules. Pressed by Senator Elizabeth Warren, Barr, who is conducting an official review of why SVB failed and what should be done to prevent such failures, said he anticipates strengthening capital and liquidity standards for banks with over $100 billion in assets.
If you had stress tests, let me put it this way. If you had stress tested Silicon Valley Bank in 2022, it wouldn't have made any difference, would it?
I don't know the answer to that question.
Well, you didn't test for Silicon Valley Bank's problem.
I agree with you that it would be useful to test for higher rising interest rates. That's why in our alternative scenario, multiple scenario that we put in place for this year's stress test, we do that. These decisions were made before I arrived, but I agree with you that it would be better to do that.
But it's like somebody going in for a test for COVID and getting a test for cholera, isn't it?
Barr noted that the Fed was aware of deficiencies at SVB as early as the fall of 2021 and warned the bank about its issues. Senators questioned why the Fed didn't further assert authorities it already has to stop mismanagement and prevent SVB from failing. Barr replied that he agreed that the Fed has, quote, substantial discretion through notice and comment rulemaking to change its rules for firms with assets in the $100 to $250 billion range, which is where SVB sat. Now, Senate Banking Committee Chairman Sherrod Brown says that he's going to introduce legislation that will give regulators more authority to impose fines, claw back executive bonuses and compensation, and ban executives responsible for bank failures from ever working in the banking industry. Again, back to you.
Excellent job, Jen Schomburger. Very interesting day once again on Capitol Hill on the heels of just a week ago, the TikTok hearing. Now, Shauna, it's interesting because we're going to talk a lot about further need for banking regulation. I just can't help but think we needed this hearing in about 32 days. After the report from the Fed is done, most of the questions that we need answering will be answered eventually by that report on what happened. And we need these people dragged back in front of the Senate. That's when some true answers will come. Is there need for further banking regulation? That's not entirely clear. It seems that this really had nothing to do with the rollback of Dodd-Frank in 2018. And we're going to talk to Cynthia Lummis, senator from Wyoming, in just a bit about, look, they had the tools in place to regulate this. But just like the high inflation we're suffering from today, the Fed was late to the party. They were late to the party in beginning to raise rates. They were late to the party in seeing the true impact of those rate increases and not seeing what was happening right beneath their nose at Silicon Valley Bank, which I think both parties agree they should have seen coming.
Yeah, they should have seen. And of course, the lack of oversight, that was a common theme that we heard throughout the day. But clearly there is a massive split on whether or not more regulation is necessary. We heard from Senator Warren, and she got all three of the regulators to agree that more regulation is probably necessary down the line in the wake of what happened at Silicon Valley Bank. Now, all three of those banking regulators, they did stress that there was systemic risk. Lots of debate about whether or not they should have acted, whether or not they should have insured all deposits and the need to do that. Let's take a listen to at least their case.
Nearly 3 weeks ago, problems emerged at two banks with the potential for immediate and significant impacts on the broader banking system and the economy. The situation demanded a swift response.
Our best assessment was that we were seeing signs of contagion in the banking system that threatened to put at risk depositors and banks across the country.
The boards of the FDIC and the Federal Reserve voted unanimously to recommend, and the Treasury Secretary, in consultation with the President, determined that the FDIC could use emergency systemic risk authorities under the Federal Deposit Insurance Act to fully protect all depositors.
So regulators, to no surprise, backing up the moves that they did make over the last 2 weeks, 2.5 weeks, I should say, saying that it was very necessary. When it comes, though, to accountability, I think that is also the big debate. How much of this lands on regulators? How much of this really should be at the blame of the SVB executives who took that massive risk? And also, what is going to be done to hold those executives accountable? Yeah,
it sounds like the talk of clawbacks is not going to go away anytime soon when it comes to the bonuses paid out and the stock sale from the former CEO of SVB. And that, quite frankly, is a conversation that needs to be had. Now, you mentioned Elizabeth Warren getting regulators to agree that further regulation is required. That's her answer to every problem in this country. Okay, let's clarify. Now, some on the right would say that no regulation is the answer too. So you just say that with a key caveat. We did speak with Wyoming Senator Cynthia Lummis, who was in today's hearing on the banking crisis. She had a different point of view on what federal regulators should have done. Let's listen.
I don't buy the notion that every time a bank fails, especially one like this that was mostly venture capital, risky capital, that we should bail them out. We did that during the 2008 financial crisis. Perhaps it was worth doing then, but I certainly don't think it's worth doing now.
Generally speaking, I happen to agree. In most cases, we need to not bail out big risks being taken. But Shauna, we'll never know if a further bank failure would have happened in the wake of all this. My guess is absolutely 1, 2, maybe 3. But we'll never know. That is certainly a point of view. Did we need to backstop all those deposits? Is further backstopping of deposits needed? That is clearly the right's point of view on this. But I don't know that we'll have a definitive answer for that ever.
No, I don't think we'll ever really know exactly how this would have played out if the regulators did not step in. But it was very clear that there was stress within the banking sector. And that was evident when you took a look at the behavior in the stock price of First Republic, and PacWest, and Western Alliance, and the names go on and on and on and on. All the regional banks that were under tremendous amount of pressure in the days and frankly weeks following Silicon Valley Bank. So certainly there was a lot of concern out there about contagion, and exactly what, though, to your point, what that risk would look like, I don't think we'll ever know.
Yeah, and you can see the rest of our interview with Senator Lummis later in the hour. I did ask her what has been put in place or what needs to be put in place that assures that something like this doesn't happen again. She'll attempt to answer that question. I hope that that's the focus of the Senate. It didn't feel like it today, though.
No, certainly not today, but we'll see. This discussion really far from over. All right, AMC shares are rising on a report that Amazon is exploring a deal to buy the theater chain. Now, Intersect Substack author Joe Belbruno writing that Amazon founder Jeff Bezos has enlisted investment advisors and top entertainment chiefs to, quote, explore acquisition plans. Belbruno's sources say that Amazon would use AMC theaters to highlight Prime Video movies and also utilize the real estate beyond showing movies. Now, the report indicating that Amazon could potentially use some of AMC's space for its grocery delivery division and create more distribution hubs. Another motive could also be data and the access that Amazon would then have to the millions of moviegoers.
The report cites one former Amazon executive saying the e-commerce giant has been pursuing a theater acquisition since launching Prime Video in 2006. AMC could be attractive for Amazon given the theater's recent track record and declining stock price. AMC, which once traded at higher than $50 a share amid the meme stock craze, is now just above $5 per share with a market cap of $2.7 billion. Yahoo Finance reached out to both AMC and Amazon for comment on the story, but haven't received a response as of 3 p.m. this afternoon. This sure is juicy. I think we could talk about this quite a bit. It's referenced as the 600 theaters being marketing way stations in this report, and it comes amid Amazon spending $1 billion to get into movies, 12 to 15 a year, Apple getting into movies around $1 billion a year, and maybe pile on top of that Amazon's first major release tomorrow, by the way, the Nike biopic Air. There is so much to this story that makes a lot of sense. If you're Amazon and you have around $70 billion cash on hand, $2.7 billion, it's a heck of a media buy. 600 theaters. You don't like it. I like that.
I just have lots of questions. I have lots of questions just about this report because, yes, I think that you can make the case as to why Amazon might be interested. But just in terms of the price right now, why not let it fall further? Which is also something that the Substack writer did point out, just in case the fact that, hey, Bezos, if he was interested in this, could wait for the share price to come back down. Obviously, shares taking off on this report. AMC is in a tough space. Obviously, I think it's a clear win for AMC just in terms of the fact that the company has struggled. Really, the only thing that has shown any life to its stock price has been the involvement in the meme trade. We know people are not returning to movie theaters at the rate that we were nearly expecting them to post-COVID. Amazon, though, that would be a heck of a lot of real estate. And I think you also have to ask whether or not they need that, though, at this point.
Our producers are going to kill us, but I'm going to add one more note.
Yes, go ahead.
Theaters cannot be converted. Almost entirely they cannot because the slant concrete floor, I've talked to many real estate executives around the country, it is almost impossible to do away with that. It is a massive cost, so you can't just turn it into an Amazon distribution center or grocery chain. You know what I'm saying? That slanted concrete
floor. Amazon doesn't need $600 million.
It sounds minor. It's actually major when it comes to development. Good story. We could talk about it for the next 2 hours, but let's do a check of the markets now. How are they? They are all down. A lot of red on this board right now. The Dow down 73 points. The S&P just slipping into negative territory. 12 points in the Nasdaq, leading in the downward direction. 78 points down. That brought to you by Tasty Trade. We are just getting started here on Yahoo Finance Live. Coming up, Wyoming Senator Cynthia Lummis says the Fed was asleep at the switch when it comes to regulating SVB and Signature Bank. Our full interview ahead. Then National Association of Manufacturers CEO Jay Timmons here to tell us why factory jobs are making a big comeback. And Lululemon set to report its quarterly earnings after the bell. We'll bring you those numbers and analysis as soon as it comes in. Don't go away.
Let's check in on Alibaba's shares soaring today. Look at that, up just about 14%. Now the move higher comes on plans for the company to split into 6 divisions. Yahoo Finance's Rochelle Akufo is here in studio from DC. Rochelle, it's so good to have you here at the desk. So tell us just exactly what this is in store for Alibaba and the reaction that we're seeing. Clearly lots of excitement.
Now, this was something of a surprise. A lot of people, they saw Jack Ma reappearing, wondering what was going on. And then the very next day, we have Alibaba using this holding group strategy here, which is really a rarity in China, dividing into 6 business units. So these are going to be Cloud Intelligence Group, headed by existing Alibaba CEO Daniel Zhang. Also, the cloud and AI business, very profitable. And you also have the e-commerce, which also includes Taobao and Tmall for all their shopping needs. You also have Cainiao's smart logistics operations. You also have the local services group. That includes things like their food delivery service at the ground level. And Global Digital Commerce Group, that's their international and cross-border e-commerce. And lastly, Digital Media and Entertainment Group. Each of those units are going to have their own CEO, also their own board of directors. But just to clarify, Zhang will still be the CEO of the holding group, but he's going to delegate operational decision-making to the heads of those 6 units. Now, Zhang said the market is the best litmus test, and each business group and company can pursue independent fundraising and IPOs when they're ready. Now, in terms of how big this is, earlier I spoke to Thomas Hayes of Great Hill Capital. He calls this a historic day for Alibaba, and great news for shareholders who've been really waiting to unlock some of the value in the company. He said this should also help Alibaba draw less scrutiny from Chinese regulators by not being such a behemoth. They were a target before when they were trying to pursue an IPO.
Cracking down on big tech. All right, some other examples of big tech doing a similar move, Rochelle?
Well, the main name that comes to mind is, of course, Alphabet. And that's when they changed their name from Google to Alphabet back in October of 2015. Now, their business unit split into Google, what we know as the search engine, also Android and YouTube, Innovation Lab X, where they do their R&D. It's VC arms, which include Google Ventures and Capital G Management Company. And Calico, its health division, DeepMind, its AI unit, several. I think by the time it got to February of the following year, they had 11 different units there. Now, this strategy allowed individual parts of the business to be more nimble, really test out some of these growth opportunities in the market. But of course, it has been a challenge to try and stay lean, especially post-pandemic. Google and Alphabet CEO Sundar Pichai looking to make Alphabet leaner and more productive under his Simplicity Sprint plan. So obviously, when you do have all these units, it is easier to try and spot where you can trim the fat. So we'll see if that ends up being the same situation for Alibaba.
We just talked about Amazon. I can't help but wonder. They're into
healthcare.
Could they break up the entertainment? I mean, I'm not saying I'm hearing that or we're reporting that, but that would be an interesting breakup.
They have options
down the road.
Yeah, we certainly have been under regulatory scrutiny. That is for sure. All right, Rochelle, thanks so much.
Good to see you.
Good to see you guys.
Great to see you. You got to come back and visit us before you go back down to DC.
You know it.
All right, well, let's take a deep dive into China's impact now on businesses, because Alibaba's announcement coming after China's antitrust crackdowns led to a record $18.2 billion yuan fine for the tech giant after a probe found that the company abused its market dominance. Here with more on this, what it means for investors, we want to bring in Brendan Ahern, CIO of Crane Shares. Brendan, it's great to see you. So just first, your reaction to this announcement here from Alibaba, what it means for U.S. investors.
Yeah, I mean, Rochelle did a great job at describing what's going to be playing out, but it's really about, as the company states in the press release, it's about unlocking shareholder value. And it's interesting that Alibaba pursued a pretty similar strategy a few years ago when they relisted in Hong Kong, that management felt like investors weren't properly valuing Alibaba's US listed China ADR. So they relisted in Hong Kong. And the whole idea was allowing local investors in Asia to properly value it. And I think a very, very similar situation is playing out today, that management is basically telling us that investors aren't properly valuing the shares. And so they're doing a very shareholder friendly move by unlocking this value.
Good to see you, Brendan. Can't help but ask, what is the deal with the reappearance of Jack Ma? And is there something with the timing here?
Well, clearly he was doing a lot more than just visiting a school in China, Dave, that clearly he was there as part of helping management navigate this. I think he's also, by doing this in a very public fashion, he's saying to the outside world that, Alibaba is here, China is open for business. It also happens to be the China Development Forum, where you have obviously Tim Cook, but also the CEO of Qualcomm, Pfizer, Johnson & Johnson, a whole host of U.S. as well as globally multinationals are in China as we speak, in a sign that China is open for business post-zero COVID removal.
Is there still, though, going to be a lot of speculation just about whether or not this actually is a shift that is going to stick? Because we've heard some comments from Chinese regulators over the last couple of months, but I think there's lots of questions about whether or not this is actually going to change some of that perception.
Yeah, I mean, ultimately, as the global economy slows, demand for China exports will slow. So the Chinese government is going to really emphasize domestic consumption, because that's one of the few levers they can actually control. And where does domestic consumption happen in China? Well, it happens on e-commerce platforms such as Alibaba, where almost 20% of retail sales takes place. Obviously, competitors like JD and Pinduoduo are also heavily involved. So I think ultimately the companies are very much aligned with top-down driven policy from China's government, which is raising domestic consumption in that zero COVID world.
Of course, there's another massive tech story when it comes to China, one that's just behind you on that whiteboard, pointing to your head. Ironically, you can figure that out later on the tape. We spoke to Wyoming Senator Cynthia Lummis about that, about the possibility of a TikTok ban. I want you to hear what she had to say.
So I'm taking the attitude of watching the continued hearings within the House Energy and Commerce Committee, and perhaps holding hearings in the Senate as well, to try to figure out how we can either wall off customer data from the Chinese Communist Party, or if all else fails, ban TikTok. I'm continuing to gather information. I think I could eventually conclude that the only way to protect ourselves from TikTok in particular is to ban it.
Now, Senator Lummis, a Republican, but there is bipartisan momentum towards an all-out ban of TikTok, as you know, Brendan. What's your reaction to the possibility of that here, and what are they saying in China about this?
Yeah, I mean, I think ultimately there's a lot of issues taking place in the United States. We have, 3 banks have failed, and just over the course of a few short weeks, we've got a debt ceiling crisis on the horizon, and we're worried about, dancing teenagers. The company's gone out of its way to show that the data is not, it's held here in the United States. Just seems like a distraction technique from some much bigger, more serious problems, in my opinion. I think ultimately, there will be a movement to try to ban it. It will go to the courts as it did in the past, and it will likely that ban will fail again. There's a little thing in the Constitution called the First Amendment, and this legislative move to ban a company just because of it happens to be owned by a company in China. It just seems like we've kind of forgotten the constitutional rights here, as well as it's worth noting, Dave, that ByteDance on their board sits a major U.S. private equity firm. The end reality is, if you try to ban TikTok, are you actually hurting many U.S. institutional investors, such as pension plans, foundations, endowments, that successfully invested in the company? I think it's something that really hasn't been examined, is the U.S. ownership of TikTok.
I'll have to debate this free speech rights against national security concerns over a cocktail in Westport. Brendan Ahern, good to see you, my friend. All right, federal regulators testifying on the banking crisis in a Senate hearing today. Regional bank stocks trading mixed in reaction. For more on how banking turmoil is impacting the markets, we turn to Kathy Jones, Charles Schwab fixed income strategist. Nice to see you, Kathy. What from where you sit is the impact on the markets?
Well, I think it's a lot of political grandstanding today, as you normally get in these types of hearings. And I'm not sure that they uncovered anything that we didn't already know. I think the upshot, though, is that there's likely to be more regulatory scrutiny around the small, medium-sized banks. These are the banks that provide funding for commercial real estate and for the commercial and industrial loans to a large extent. So if you add regulation on top of the fact that they're probably already looking at their assets and liabilities and their positioning to make sure that they're in better shape, there'll be tightening credit conditions, and that will probably slow the economy. So all this may be have been going in slow motion, but now it will probably speed up as a result of these problems.
How soon then, Kathy, could we potentially see a recession?
Well, I wouldn't rule it out for the end of the year, although it's really always tough to time these things. But certainly the end of this year into 2024, barring some sort of major surprise in looser financial conditions, which doesn't seem likely, I would say it's a 6 to 12 month time frame that it's a pretty high risk of recession.
The tightening lending conditions that result from the collapse, does that equate to some measure of tightening from the Fed? And do you expect further Fed tightening at the May meeting?
Yeah, it certainly does. It's hard to model out exactly how many basis points this is worth. We really won't know until we get further into it. The Fed is currently still projecting another 25 basis point rate hike at the May meeting. That's their intention right now. I'd be surprised if there was a major reason to do that. But I have been surprised that in the midst of all this turmoil, the Fed kept hiking rates anyway. So I suppose if they really desperately want to get another 25 basis points on the books, they'll go ahead and do it. But I think it just adds to the risk to the economy.
And Kathy, Wall Street is very, very split just in terms of the Fed's next move, whether or not it should hike, and also potentially the timing about whether or not and when it should cut. We heard from Evercore ISI's Krishna Guha earlier today, and I want to play a quick thought here from him and then get your reaction.
Bar for pausing is not that high, but the bar for cutting is much higher. And it's not just higher in a quantitative sense, it's higher in a qualitative sense as well. Meaning that you can pause on a sort of expectation that things are going to move in a more disinflationary direction. But in principle, at least, you're only cutting upon substantial further realized progress in moving towards inflation heading back towards target.
That was Krishna Guha of Evercore. Kathy, what do you make of his comments and what that could potentially mean for the Fed by the end of the year?
Yeah, I think he hit it on the head. There's this conflict between the perception of what the Fed will do and what the signal it wants to send. It doesn't want to send the signal that it's going to lower rates unless inflation is really actually declining pretty significantly, not just the expectation. So I do think he's hit it on the head in terms of this is a signal that the Fed wants to send. The reality is, though, that we have the potential for a significant slowdown in the economy, rising unemployment, falling inflation. If we're headed in that direction and there's stress in the financial system, it's going to be hard for the Fed to just sit on its hands. That doesn't seem to make a lot of sense.
All right, we agree there. Kathy Jones, nice to see you. Thanks so much. All right, let's get a quick check of the markets now, sponsored by Tasty Trade, continuing to fall all in the red right now, albeit just slightly for the moment part. The Dow and the S&P just tipping in about 0.5% for the S&P, and the Nasdaq 0.8%, just about 100 points down on the afternoon. We'll dissect all that market action later on in the program, but that check brought to you by Tasty Trade. Still coming up here, Apple introduces its buy now, pay later service. Find out how it works and what it means for investors when we come back.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Apple, Paramount, and McCormick. First up, let's take a look at Apple. The company is now a player in the buy now, pay later industry after unveiling its new service, Apple Pay Later. Now, here's how it works. Apple said that users can apply for loans of $50 to $1,000 and can be used for purchases made on iPhones and also iPads from sellers that are accepting Apple Pay. Users can apply for a loan through the Wallet app, and when you apply, that's not going to impact your credit, but these payments are going to be split up into at least four various payments there in order to complete that purchase. Not everyone, though, is going to have access to this yet. The tech giant giving it to select users first and then plans to roll it out to all eligible users in the coming months. We're seeing some reaction when you take a look at some of the competitors within that space today. So Apple's down on the news, but when you take a look at PayPal, Affirm, those stocks also took a hit on the news that Apple is officially entering into this space. And Ali, Apple really sees a runway for growth here when it comes to buy now, pay later.
Certainly, if you're a competitor, this is devastating news considering the hold that Apple has in the tech space. I don't know why this makes me a little nervous, because for me, when I use Apple Pay, I'm constantly whipping out my phone, tap, tap, tap. I don't even know how much I'm spending on. And even though there's no interest rates, no fees, like you said, it's not going to negatively impact your credit score. You do have to put a debit card down, and if you don't have enough cash in your account at the time of the repayment, you'll likely get dinged a fee from your bank. So the cautious spender in me is like, I don't know if this is a great idea. However, you do have more options for consumers and for Apple services business.
I think we get a lot more people using Apple Pay in that regard.
You're speaking my language. I just want to say thank you for that. By the way, you saw Affirm down 9+%. That is a massive hit on this news. But yeah, my reaction is as a parent. Yes, this is a great investor story. This is a great Apple story. I think it's terrific. I think they're going to take over banking. But let me just reiterate what Shauna said. No interest, no fees, no impact to your credit score, and no theory, no accountability if you're these young people, with all due respect, who have no concept of what a dollar is because they simply swipe their phone and forget about it. They never held that money. They held that paycheck. My children or our teenagers don't ever carry cash nor a credit card. This compounds the problem that they have no accountability for the money. Your kids are too young.
I know they are too young, and I totally
terrifying
agree with what you were saying, but I also say I think you can make that very similar argument when it comes to credit cards. A lot of people don't realize that what they are putting on credit cards needs to be paid by a certain time, or else your interest is going to go up. You're going to end up owing more than what you actually paid for whatever products you did buy. I agree. You got to talk a lot more about finances within the Briggs household.
We all do,
and
man.
Yes, in my household too. Yes, that is for sure.
Yeah, maybe if anything, it'll spur more conversations about how to handle your money.
Probably not, but I hope you're right.
We'll never know. All right, well, moving on to my play, it's Paramount Global. Shares seeing a boost today, up around 3%, following an upgrade from Bank of America. Analyst Jessica Reif-Ehrlich upgrading shares to buy from neutral, in addition to raising her price target to $32 a share, up from the prior 24. The analyst cited potential upside if Paramount were to sell all or parts of its business, writing, quote, "It is our view that Para has a unique collection of assets that would generate significant buyer interest if ever put up for sale, either in pieces or whole." This upgrade, of course, comes amid recent reports of a potential sale of the company's BET Media Group, in addition to a reported offer of $3 billion plus for Showtime from former executive David Nevins. Paramount has long been rumored as a potential acquisition target due to its small size relative to competitors, with Ehrlich adding Nickelodeon, Paramount Studios, and CBS Networks could also be in high demand given their strategic value. Shares were up as much as 8.4% earlier in the session and have climbed more than 25% year to date. And guys, for me, when it comes to Paramount, it's not necessarily a question of if this is going to happen, but more so when. Obviously, this is not a great deal-making environment right now, but I do think this is a company that could be very attractive to some buyers out there.
Yeah, the last week has been alive with conversations on BET when it comes to Sean Diddy Combs, Tyler Perry, Byron Allen, all entering the bidding for that. 3 media heavyweights already in on that, so I agree with you. A matter of when, not if. My play is McCormick and Company. MKC, a trending ticker on Yahoo Finance, and shares are surging after a rather Spicy earnings report. The maker of Frank's Red Hot crediting an 11% increase in sales to pricing action, which helped offset some of the volume declines. You've heard that over and over the past couple of months. Gross margins also dropped 80 basis points to 36% in the first quarter. That's less, though, than the 380-point decline in Q4. The CEO, Lawrence Kersey, is saying earlier, price elasticity is not a major factor for us, adding most of the company's prices are in place for the year. Now, McCormick on track for its biggest one-day gain since March 2020. You know what happened then? The early days of COVID, when we knew lockdowns were coming. The stock up more than 9%. Just last week, they updated their packaging. First time in 40 years to better maintain freshness while incorporating recycled content. Quick conversation here, guys. You get 2 spices in your whole rack. You don't get salt and pepper, don't count. You get 2 spices. That's it. Cinnamon and cumin are mine.
I was going to say cinnamon,
what do you
definitely. Cinnamon, cumin's a good one, although it has to be McCormick?
No,
everything
2
but the bagel
spices.
seasoning from Trader Joe's. If you haven't tried it, you got to try it.
Fantastic.
Easy.
Oregano, cinnamon.
Oregano's
There we
another
go.
good play.
Oregano.
Love a good oregano.
Cinnamon is the winner today.
All right, and you got to try everything but the bagel seasoning from Trader
I
Joe's.
have.
The
It's
best.
remarkable.
Oh, yeah. All right, it is
Leaves
the
a
best
mark,
seasoning
though,
I've ever had.
on the breath.
McCormick might have a knockoff of that soon. All right, well, coming up, lawmakers on Capitol Hill shifting their focus to the bank crisis. U.S. Senator Cynthia Lummis telling us why she thinks regulators should have let Silicon Valley Bank fail. Next. Banking regulators facing a grilling on Capitol Hill. Now, earlier today, lawmakers wanted answers after 2 bank failures at Silicon Valley Bank and Signature Bank earlier this month. One of the senators on the banking committee is Wyoming Republican Cynthia Lummis. Now, we asked Senator Lummis if there should be stricter banking regulations earlier today, and here's what she had to say.
When I look at the statutes and the rules that exist today, it looks to me like they have plenty of authority to supervise banks. And they don't have to just look at interest rate risk. They can look at how many deposits are uninsured. They can look at qualifications of the board members. They can look at a myriad of risk factors that were apparent with Silicon Valley Bank. So I just think they have plenty of authority to do what they need to do to regulate these financial institutions. So there were two things, as I see it, going wrong here. The bank was mismanaged, and the Fed was asleep at the switch.
That then begs the question, what can we do? What needs to be done to assure that this doesn't happen again?
Yeah, great question. I think that we need more transparency, for one thing, between the Fed and Congress, so we can make sure that they are conducting these bank examinations using the full authority that they have under statute and under rule. I also think that instead of looking at the notion of increasing the depository insurance levels from $250,000 per account, that we should make sure that the onus is on the individual depositor. If they want insurance over and above $250,000, they should buy insurance through the private market and not rely on the system as a whole to bail them out during a crisis such as this. One of the things that I learned at today's hearing that did encourage me is that there's some options within the FDIC to carve out some financial institutions from having to participate in the costs of bailing out SVB and other financial institutions such as SVB. So that's good news. And I'm going to be watching that closely because I just don't believe Wyoming community banks and other small community banks should have to participate in this bailout.
Sure. And to that point, there are many questions about whether or not we should have backstop. Regulators should have backstopped SVB. And that question was put to the FDIC chairman as to what might have happened had we not. I want you to listen.
The evidence suggested from the sequential failures of first Silicon Valley and then Signature that there was a significant risk of contagion to other institutions.
You're saying the actions taken were the least bad option for small businesses and banks across the nation. If you hadn't acted that way, you think there would have been a contagion?
I think there would have been a contagion, and I think would be in a worse situation today.
And we have seen some contagion, if not some ripple effects around the globe in the banking system. What do you believe the reaction would have been, the contagion, if we had not backstopped SVB?
Well, I think we have to let some of the moral hazard associated with mismanagement like this exist and let these banks fail. I don't buy the notion that every time a bank fails, especially one like this that was mostly venture capital, risky capital, that we should bail them out. We did that during the 2008 financial crisis. Perhaps it was worth doing then, but I certainly don't think it's worth doing now.
Well, Senator, what happens, though, if they didn't act? Would we have seen more bank failures?
Nobody knows, and we'll never know because they backstopped it. And so there is no moral hazard. The message to banks is the government's going to bail you out. So, you know, if you're an important enough bank or you have an important enough board or you might make the right political contributions to the right people, we're going to bail you out. And that's not the way this system should work. I think that they should have been allowed to fail, and we should have taken a wait and see attitude with regard to other financial institutions.
And Senator, when it comes to accountability, you mentioned mismanagement there, and that is something that has been talked about time and time again over the last several weeks. What needs to be done to hold these executives accountable? And we heard from Senator Brown today in his testimony, in his opening statement, I should say, saying that he's planning legislation that would increase penalties for executives at failed banks and also ban them from the industry. Is that something that you would support?
I think I'd rather look at clawing back their compensation. I sometimes think that the irresponsible actors in any industry are the ones that are inviting over regulation. So I'd rather see the penalty apply to these particular bankers' compensation as opposed to more generalized approaches. Over-regulation and Dodd-Frank, in my opinion, included a tremendous amount of over-regulation, really hurts small community banks and makes it difficult for them to survive. We really created a system in 2008, 2009, where banks were both too big to fail and too small to succeed. And if we use this example as a way to once again craft more regulation to contain a small group of bad actors, we're just exacerbating the problem for small community banks that are absolutely necessary in a state such as mine. Literally, there are banks that will not bank people that are having account sizes and business sizes that are the norm in the state of Wyoming. So we need to protect small community banks. They're more nimble, they're directly related to their communities. And this is the bank that I'm the most worried about.
Our thanks to Wyoming Republican Senator Cynthia Lummis on today's banking hearing. Meanwhile, new leadership is taking the wheel at ride-sharing giant Lyft, which initially drove shares higher today. Then the stock shifted to reverse. As you can see, how about 3 puns in just one
I was
intro?
going to say, this is impressive.
Really good, man. Down 7%. Their new CEO, former Amazon executive David Risher, said today that Lyft is, quote, not for sale. And as you can see, shares are down 7%. Meanwhile, Lyft co-founders Logan Green and John Zimmer will step down from their management positions. Green and Zimmer will stay on as chair and vice chair of the Lyft board. So what does this mean for investors? Tom White, he loves a good pun or two, I hope. He's a senior research analyst at D.A. Davidson. Good to see you, man. So we'll circle back to the no sale, but let's start with the new leadership. What does it mean for investors in Lyft?
Yeah, look, I think it's, first off, thanks for having me. Look, I think it's a little too early to tell ultimately what it'll mean. You know, our initial take is that we're inclined to view it as probably a net positive, albeit a modest one at this point. I think, it's probably about the right time for Lyft to get some new perspectives, potentially broaden the kind of strategic aperture of the company a bit. If you think back to kind of the DNA of the company and the co-founders specifically, it's a management team that really was, very focused, singularly focused on disrupting transportation and kind of sticking to that part of the business, even while some of their competitors were kind of leveraging a rideshare business and expanding into other adjacencies. And that's, clearly worked out for companies like Uber. Lyft has kind of really had a more narrow focus. We think a new management team may help kind of broaden the focus a little bit and hopefully find new ways to create value for this company.
Tom, what do you think the top priority should be for new management?
Well, I think that's a bit of the problem. I mean, it's not necessarily, what he can or can't do. It's sort of how much it'll cost and whether it'll cause sort of a further reset of kind of the profit targets that investors have kind of come to expect. This new CEO, David Risher, it's been a while since he's been, kind of in an operational role at a publicly traded company. He was at Microsoft in the 90s. He was at Amazon kind of around the turn of the century and left there in 2002. Since then, he's been primarily kind of working to advance literacy globally, which is obviously a very worthwhile pursuit, but doing so as the head of a nonprofit, and he's had some other board seats. Apparently his skill set is really about execution and kind of the minute details that need to be ironed out to get a marketplace really humming. So, I guess there's probably a little bit of room for Lyft to make improvements on kind of the marketplace operations part of their business. But I don't know that any of that stuff is like a huge needle mover. I think a bigger needle movers, would be kind of more creative approach around new products, maybe getting aggressive with new partnerships, and maybe exploring other kind of novel ways to create value, like a sale or some sort of transaction.
Yeah, he says, I don't want to get in the car with someone that's just delivered a pizza, so I guess we can rule out food delivery for the near future. He said it's not for sale. Does that mean they won't pursue a sale in the next couple of years? What would that mean to Lyft? And can you throw out any names that might be a potential buyer?
Yeah, look, it's a publicly traded company, so even if he says it's not for sale, it's technically for sale every day. The thing to keep in mind here is that they do have a dual class structure for the shares, and because of these super voting Class B shares, Logan Green and John Zimmer control something like almost 33% of the vote. So, for the company to be for sale or to decide on selling itself, those guys would presumably have to be on board most likely. In terms of potential acquirers, I think you're looking at the large kind of consumer internet platforms here in the U.S., and you're also possibly looking at some of the large global auto OEMs. And, coincidentally, both of those groups include companies that are focused on autonomous driving, self-driving taxis specifically. So, names like Waymo, which is part of Alphabet, so again, some of the big auto OEMs would appear to be the most likely in our view. Given the pullback in Lyft shares over the last several quarters, it's only about a $2.5 billion enterprise value at this point. Maybe you get some kind of less obvious strategics that would be interested, but we don't view a kind of a transaction or a sale process as imminent in any way. But never say never.
Tom White of D.A. Davidson, thanks so much. Again, Lyft shares off just over 7%. Well, coming up, we are counting down to the closing bell on Wall Street. All three of the major averages trading to the downside. Look at the Nasdaq off just about 0.5%. We'll be right back. We're just about a minute away from the closing bell on the street. Let's take a look at Alibaba. It's one of the trending tickers today. Shares on track to close up just over 14%. Now the move to the upside coming after the company made the announcement that it's splitting into 6 divisions. Lots of talk about the fact that this was done to appease regulators. We know Alibaba has really been in the spotlight when it comes to Chinese regulation. Some talk there about what exactly the future of Alibaba should look like, Dave. And when you take a look at this move and the stock reaction, the street obviously very excited about some of the potential that this could unlock.
Yeah, the investors love it. And Brendan Ahern, Crane Shares CIO, joined us earlier and said this is about unlocking shareholder value, adding investors aren't properly valuing the shares, so management is doing a very shareholder-friendly move by unlocking this value. Interesting, the timing of it all is certainly among the most intriguing aspects of this. Jack Ma, who had been AWOL for several months, returns just as this news breaks, reportedly visiting a school there. You can see shares also, KWeb up 4%, Baidu up 4.6%, JD.com up 4.4% as well. And there is your closing bell on this Tuesday.
Yes. Certainly keeping some of the losses that we're seeing across the board in check there, Dave, because those were the outperformers of the day. But when you take a look at the major averages in this market check sponsored by Tasty Trade, all 3 of the major averages closing in the red, well off their lows of the day, though, with the Dow off 37 points and Nasdaq off just about 0.5%.
All right, let's check on bank stocks as well. Regionals ending the day in the red. PacWest down, let's see, about 5% on the day. Western Alliance down just fractionally. And First Republic continues to fall, down 2.5%. All of this moving on the Senate banking hearing today, which certainly was an interesting back and forth as they pressed regulators on the Fed's inability to stop the SVB collapse. And most of the references today were about this ongoing report, which frankly we will not see until May 1st. So yes, a couple of senators referenced the fact that they need to come back before the Senate after that report is released. Elizabeth Warren, who you see there, got some very satisfying answers and the need for more regulation. But again, the question is more regulation really the answer here? Cynthia Lummis, who joined us earlier, said the Fed had all the tools in place to further regulate and to stop this collapse. Again, the Fed late to the party in raising rates, late to the party in seeing this SVB collapse coming. I don't know that really all that much was accomplished today in this hearing, but we did start a meaningful conversation, one that's not done until we get a public accounting of what happened and dissect that report in early May.
Yeah, certainly. And I think a lot of the talk here is just about the risk that was taken to SVB specifically and why that is so different than some of the balance sheets that we are seeing from many of the other banks. When you take a look at these losses, though, First Republic off about 88%, nearly 90% in the last month. Obviously, a lot of those losses coming in the last 3 weeks. PacWest off about 66% in the last month. So a lot of that concern, maybe some of the jitters that we initially saw in the wake of SVB's collapse, that at least has been settled for now, but certainly lots of questions remain about what the future looks like for the banking industry, whether or not the debate over if more regulation is needed, and then, of course, the fully backstopping all deposits as well.
I should add the KRE, which is the regional banking ETF, essentially flat today, down just fractionally, gives you a pretty good sense of the regional banking sector altogether.
It certainly does. All right, and let's also take a look at Walgreens. That stock rising today after beating the street's expectations on its fiscal second quarter earnings. You're looking at gains of just about 2.7%. Some positive commentary from the street on the heels of these results. RBC calling it, quote, a solid quarter here for the company. And this beat here coming amid the backdrop that the landscape here for Walgreens, as it is for a lot of its competitors, is changing post-COVID. We know testing, we know vaccines was a massive driver of some of their sales over the last 2.5 years. But the vaccines administered, that number dropping about 80% compared to a year ago. Testing off more than 90%, although obviously not a massive surprise there.
Yeah, that's the big draw today. Profit down 20% on that. But look, their new CEO is focused, and I think the exciting opportunity, if you are an investor in Walgreens, has to be the entry into primary care and their continued focus on that through Village MD. That is what you heard about a lot on the call today. added focus on primary care, which is a huge opportunity for Walgreens. Also, they did reference a massive employee shortage in terms of pharmacists. 1,900 stores are currently short-staffed and running less than full hours, which continues to be a problem for Walgreens pharmacies across the country. But a pretty solid report given that massive drop-off in COVID vaccines. Okay, the collapse of Silicon Valley Bank raising new questions surrounding the role of social media in one of the largest U.S. bank runs on record. Yahoo Finance's Ali Canal here with the details. Ali, nice to see you.
Nice to see you. Yeah, social media, this modern day wrinkle in what otherwise was a very classic bank failure. We heard from Jerome Powell last week saying that management failed badly in the years leading up to SVB's demise. But still, despite that mismanagement, we did hear earlier today from Federal Reserve Vice Chair Michael Barr speaking in front of the Senate Banking Committee. He said that modern communication dynamics were at the heart of this collapse, particularly how fast this all occurred. In his written testimony, he wrote, quote, social media saw a surge in talk about a run, and uninsured depositors acted quickly to flee. Depositors withdrew funds at an extraordinary rate, pulling more than $40 billion in deposits from the bank on Thursday, March 9th. And that panic is what ultimately led to the collapse of the bank on Friday, March 10th. We also heard from FDIC Chair Martin Grunberg. He echoed Barr's view in his own testimony on Tuesday. Here's a quote. He said, one clear takeaway from recent events is that heavy reliance on uninsured deposits creates liquidity risks that are extremely difficult to manage, particularly in today's environment where money can flow out of institutions with incredible speed in response to news amplified through social media channels. And this also speaks to the rise of mobile banking, the advancements that we've seen in those digital tools like self-service money management, where the transfer of cash and information, it's just at the quickest pace that we've ever seen. And because of all of that, it's a clear game changer. That's an actual phrase used by Citigroup CEO Jane Fraser. She described that last week while speaking in an interview when it comes to the future of social media. She, along with other regulators, seem to be all on board right now that concrete structural changes are needed, especially in regards to social media moving forward.
And speaking of some of those structural changes that could maybe potentially be on deck, it's interesting when you take a look at how Fed Chair Jay Powell has reacted to this, because in the press conference last week following the Fed's decision, he reiterated time and time again that he thinks the banking sector is sound and resilient. How do you see this impacting maybe the Fed's policy here down the line?
Well, you did mention that there will be a full Fed review that will be released on May 1st. I think we're going to get more clear messaging when it comes to potential regulatory reaction from this. But Fed Chair Jerome Powell, he did speak specifically about this banking failure last week. Here's a little bit more of what he had to say.
Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest.
So Powell really focusing on that speed, the speed at which this really unraveled. That is largely what's going to lead to regulatory review down the line. What tangible policies will be in place, we don't know at this point. I think this will be an ongoing conversation, and social media is going to be a very heavy part of that for even stress testing moving forward. Potentially that could be a thing as well.
Yeah, massive. Very Ali Canal, great stuff. Thanks so much. We want to get to some breaking news. Lululemon releasing its fourth quarter results. Josh Schaefer, what do you have?
Yeah, so Lululemon, we've got a beat on the top and bottom line here for the last quarter, the fourth quarter. Revenue coming in at $2.77 billion. That is against estimates of $2.7 billion. And adjusted EPS coming at $4.40, and that's against estimates of $4.26. Now you see that Q1 EPS, the guidance there also came in above Wall Street estimates. And then two key numbers here, also forward-looking, guys. Full year net revenue coming in at $9.3 to $9.4 billion. That's above the estimate, the street estimate for $9.1 billion. And then full year EPS coming in at a guided range of $11.50 to $11.72. That comes in again above the street estimate of $11.27 for full year EPS. But one key number we were talking about going into this report is that gross margin number, and that number did miss street estimates for the fourth quarter. So the fourth quarter gross margin number coming in at 55.1%. The street had been looking for 57.1%. So 55 versus 57 there. That's something that I'm sure will come up on the call, and I'm interested to hear more about.
Yeah, certainly. And when you take a look at that inventory number coming in below the street's expectations, obviously you would think that's a good sign here for Lululemon as the company tries to get more of a control over their excess inventory. It looks, at least for now, that the street is looking past that gross margin miss. And a lot of the focus in this report is on these results, but also maybe more so on that guidance number. When you take into account that revenue, the outlook here, full year net revenue outlook, $9.3 billion, $9.41 billion. Beating the street's estimates by a wide margin. The street was looking for $9.1 billion. And I think this really shows a couple of things. One, that the consumer is still spending, that Lululemon is able, at least up until this point, to maybe navigate what is a very challenging time for this company. And inventory was a big concern, like you said, going into this. Lots of questions about whether or not they were going to be able to get a handle on that, given their sales structure and how they approach sales. Looks like, though, at least they made maybe enough improvement on that to satisfy.
Well, Lulu's been the kind of company that grows on a continuously growing net sales number, right? So to see that number continually going up, I think is what people are excited about here to some extent. When you think about Lulu, they're not as promotional as some other retail companies. So people are wondering, can they continue to sell and offload that inventory without promoting too much? So you're seeing a little bit of that margin pressure, but I think the big thing here, Dave, is to just continue to see that revenue number potentially growing into next year, basically saying if maybe demand is hurting in some places, but maybe not for the high-end consumer that Lululemon sees.
Right, and that's the thing. They're immune to a lot of other challenges to the other retailers that we talk about because their shoppers are fiercely loyal. They are that far high-end shopper. And just look at this number. This is from a data number just out. Visits to Lululemon stores up 11% in February, while visits to sports apparel across the board down 7.6%. So that is a massive discrepancy, a massive difference between Lulu and everybody else in the category. Their consumers are not feeling the same pain as these other stores. As you can see, traffic continues to pick up. Now, some attribute that to being more experiential in the stores because they do have a lot of activity, including yoga in stores. But that number really tells the tale. Fascinated to see the inventory getting a handle on that number as well.
Yeah, exactly. And also another piece in this report that's pretty interesting. We talked about Lululemon and Lululemon Studio, and their membership there, which is formerly known as Mirror. Well, the company actually launching a new app. It sounds like it's going to be launching in the summer of 2023. They're expanding the Lululemon Studio premium tier. They're going to enable guests to access its digital fitness content via that new app. It's going to also be offered for a lower monthly fee. So we'll see what they expect in terms of traction, how often that will be used. But again, another source of revenue here for the company going forward. All right, Josh, great stuff. Thanks so much. Well, we'll take a deeper dive into these quarterly results here from Lululemon when we come back.
Lululemon shares jumping after reporting fourth quarter results that beat Wall Street estimates. The company also offering upbeat guidance as well. Joining us now for more on the report is David Schwartz, Morningstar equity analyst. Good to see you, sir. So a beat on the top and the bottom and on revenue by $100 million. We'll give you a blank slate there. What jumps out to you about the report?
Yeah, Lululemon once again beat estimates, beat its own pre-announcement from back in early January. That's not a big surprise. Lululemon has a long history of beating estimates. It's done it almost every single quarter over the last 4 years. And it also has a history of really kind of sandbagging the street with kind of low numbers. And I think that Lululemon once again reported another very strong quarter and beat all the estimates that were out there.
David, what do you make of the inventory number that we got? 1.45 billion, estimate was for 1.51 billion. Enough improvement for you?
It is definitely inflated. It's basically exactly what I had in my model. The inventories have been trending higher over the past year plus, certainly higher than in pre-pandemic years. But, Lululemon has introduced a lot of new products. In fact, just in March, Lululemon has introduced a new line of men's workout apparel, a number of new women's clothing items. So Lululemon has a lot of new products out there. Their inventories are probably going to be higher, more on a permanent basis now that it has a far larger number of SKUs than it used to have. But it is a concern because the gross margin did get hit in the quarter. It was a couple points below my expectation. And Lululemon doesn't like to really talk about discounting too much, but it does look like Lululemon had to resort to more discounting than normal to get that sales number that they posted.
Oftentimes we've seen a beat on the top and the bottom, shares rise, and then as we digest guidance, we see shares begin to fall. Not the case here. What do you make of the guidance for Lulu?
Guidance is good. It's not that different than what I had before. Again, Lululemon has a tendency to put out kind of low numbers that it can beat. And so, I think I'm going to be raising my numbers, and I think most analysts will, perhaps even above Lululemon's guidance. So it is a company that has a history of beating estimates. You look at the valuation. I do think that Lululemon is overvalued at these levels. I don't necessarily like it at this price. It often is traded at PEs over 50 at times. It's no longer that expensive, but you're still talking about a pretty high PE for a clothing company. And really, I wonder if Lululemon can continue to post these great numbers year after year.
David, what about the Studio Premium program here? Because I bring that up. It was mentioned within this release. They're going to be expanding it. They're launching a new app. They're also launching a lower monthly fee option. How big of an opportunity? Is this a big opportunity for Lululemon?
Traditionally, Lululemon hasn't really needed any kind of loyalty program or membership program because it has such a large installed base of customers and very loyal customers. I do think that it's something that can be additive to Lululemon. I think that it probably will be popular because the brand itself is so popular, and so many of their customers are younger women, especially. I think that they'll respond to this kind of thing, and I think they'll be interested in any kind of connected fitness and new apps. It's also a bit of a failure, though, of the Mirror product. Let's face it, the company bought Mirror for $500 million, and it hasn't really worked out at all. And so they're really trying to find a way to incorporate Mirror with the rest of Lululemon, and it's unclear that it's really working.
Indeed. Placer AI says Lulu visits are up 23% in January when sports apparel stores were down 5.5%. In February, up another 11%, while all sports apparel companies were down 7.6%. Why is Lulu immune from the same challenges the category faces?
Well, it's not entirely immune. We did see the degradation in the gross margin, so there was some impact there. But, we're definitely Lululemon does better than just about any other store out there. And this has been the case for 4+ years now. It draws traffic. There's just a lot of people that go to Lululemon on a regular basis. But, it was kind of a mixed quarter for the sportswear industry. Although some of the numbers you cited were negative, you have to remember also like Dick's Sporting Goods reported a strong quarter. Yeah. And so did some other sporting goods companies. So it wasn't really a bad quarter. Nike's earnings were okay. They weren't great. Some other companies like Adidas clearly are struggling badly. So it's kind of a mixed result right now across the board in athletic wear. I think that Lululemon certainly is at the top of the pack, but the industry itself, I don't think is in really bad shape either.
David, how worried, though, should Lululemon be about some of its smaller competitors out there? We certainly have seen the rise in popularity of Vuori, of Alo, just to name two of those smaller names within that space. Should Lululemon be pretty concerned with some of the traction that those names are getting?
Yeah, I think so. I mean, there's also Fabletics, there's Athleta, which is owned by Gap, of course. There's so many other companies out there making leggings and sports bras and the kind of products that Lululemon sells. Lululemon does it better than anybody else and have the highest prices, compared to anybody else. But there is competition. It's not a one company business. It's a business that everybody wants to get into because everybody's envious of Lululemon's success.
Can argue with that. David Schwartz, good to see you. Thanks so much.
Thanks.
Coming up, National Association of Manufacturers CEO Jay Timmons here to tell us why manufacturers want to expand trade with Europe. Next. The country's major retailers from Foot Locker to Walmart were in Vegas this week for a huge annual industry event called Shop Talk. Yahoo Finance's executive editor Brian Sazia had a chance to talk to Ulta Beauty COO Keisha Steelman about the company's growth, where consumers are shopping, and what could come next for the retailer. Let's listen.
The consumer right now is loving coming into the Ulta Beauty store. I think one of the things that makes us really unique is that we offer everything that she could want, from mass to prestige, hair, skincare, wellness, etc. The consumer is still coming in and they're spending with us.
What is the magic of Ulta? Full disclosure, I go to Ulta, I get my face creams at Ulta. Explain some of the magic that I see when I walk into one of your stores.
Well, I'm happy that we're able to take care of your skin, Brian.
I'm really 25.
Yeah, it looks great.
Oh,
it looks great. It looks great. I would say that, when you come into an Ulta Beauty store, we're there to help you be your best self. And we're not, intimidating. We're open. We create an environment where people can truly be their authentic self when they come into the store. And we also cross all price points, from mass to prestige to masstige. So we have something for everyone when you're coming coming into the store location. And I think that's really resonated well. 95% of our consumers are Ulta Beauty enthusiasts that are in our loyalty program. So we know what they're shopping, we know what they're buying, we stay really close to them, and we're listening to what they're wanting from us, and we continue to add more to the assortment to give her everything that she wants.
What are the hottest areas of an Ulta store right now?
Oh, the whole store is hot, Brian. The whole store is hot. But I would say one of the categories that we're really seeing that's coming through COVID that's really stuck is wellness. The consumer is really focused on wellness in addition to all their beauty regimens, which is great because wellness was really important as we were going through COVID. But, now that people are getting back out and going to parties and being more active, like places like Shop Talk, they want to put makeup on and they want to get glammed up a little bit more. So we're seeing wellness stick, and we're also seeing them really lean in a little bit more to cosmetics, which is great.
Where is Ulta in the services journey, and what are you focused on this year in that area?
Yeah, so our services, it's fantastic because we have services in all of our locations. We have hair, skin, brows. What we've seen is that the consumer is really still focused on color for hair and also hair health. So hair health and wellness and thickening, and that's really important to the guests still right now today. So they're coming in for our salon services, brows, men and women both are coming in to get their benefit brow services.
I can get my brows done in Ulta?
Yes, you can. We'll take care of that. We'll take care of that for you.
Where is the men's section? So I go into an Ulta, I just told you I shop there.
Yep.
Is there going to be a day, and when might it be, I can go in there and I have a dedicated men's section that I could just go in there and buy men products?
Well, I absolutely know that we do care about the men that are shopping at Ulta Beauty. And I'd say that there's sections all throughout the store. We may have to get you some guidance as you're coming into the shop, but we have products for men in all of our locations. But, I would say lean more towards online. Our .com, it's a little bit easier to maybe navigate for the men right now today. But we're going to continue to focus on men. They're important to us, and we got to keep you looking good still, Brian.
I appreciate that. So you mentioned the loyalty members, over 40 million?
Yeah, 40.2.
What are you seeing? How are they spending with you right now, and how do you plan to leverage that data moving forward?
Yeah, what we're really pleased that we see is that the consumer across all income sectors is spending at a great pace. There's not one income sector that's outperforming another. So it's very consistent across the spectrum. And I think part of that is because we do offer everything in one place across all price points. The consumer is really pleased with what they're seeing in Ulta Beauty. And, that loyalty penetration, that membership is still remaining high. We're just come off of a fantastic year, hit 10.2 billion in sales with that 40.2 million customers that are coming in. So, the customer is in our loyalty program is liking what they're seeing, and they're coming into our stores and they're shopping online too.
I really found this interesting. This is the first time we talked. I follow you on Instagram, but you started working in a Target store.
I did.
Now you're seeing or running or helping to drive the Ulta inside of Target stores. How did you get here?
Yeah.
Talk to us about your career path.
Yeah, I would say through hard work and a lot of mentorship along the way. I did start at Target in the early days, making $8 an hour on the sales floor, and I could not be more proud of our partnership with Ulta Beauty at Target. It was a full circle moment for me. I'm blessed that I started my career at such a great retailer. They invested a lot in my leadership and my education and the skills to really do the job that you need to do in retail today. So very thankful for that, the early years at Target, and then just continued to grow in my experience. And I'm a big believer in the answers are in the stores. So you mentioned that you follow me on Instagram, and I'm in the stores a lot. The answers are on the front lines with our associates, and when we listen to them and we're taking care of their needs and helping them do their jobs better, it really translates to the guest, and the guest will spend more with us. So, I would say it's been a great journey. I feel very blessed and fortunate to have worked with such great retailers, but I think I'm with one of the very best today here at Ulta Beauty.
Ulta Beauty COO Keisha Steelman, and of course our thanks to Brian Sazzi as well. We'll be right back. Ulta shares closing higher today as Canaccord Genuity initiates coverage on the stock with a buy rating, a $622 price target, looking at shares closing up just about 2%. Let's talk to the analyst behind that bullish call. We want to bring in Susan Anderson, Canaccord Genuity analyst. Susan, it's great to see you here. So you think Ulta still has a ways to go in this rally. Why are you bullish?
Yeah, so the beauty category itself, we really haven't seen slow much. It definitely had some rebounds post-COVID, but it's continued to be strong into this year. Credit card data is showing it actually picked up in February, and then that strength continued into March. So, I think that's only going to benefit Ulta. We also see them as a share gainer despite the higher growth category. We see them taking share from department stores, particularly as they roll out their prestige business further, and then also add luxury such as Dior to their lineup of brands that they sell in the store. Also, the robust loyalty program that they have, we think has benefited them. They're able to really connect with their consumer through that program and drive sales through it. So I think that's also been a differentiator. And then finally, their omni-channel capabilities. So they've been able to sell, wherever the consumer wants to buy, and they really saw a robust online business during COVID, which has continued. It's just over 20% of their sales now. And we think that's beneficial to them as well. So we continue to see them not only as being a share gainer in the space, but also benefiting from the very strong beauty trends.
Yeah, their COO just told Brian Sazzi $40.2 million in that loyalty program. Impressive. Susan, how significant is the partnership with Target in terms of driving future growth?
Yeah, so in 350 doors, they're rolling out to more. I think it's been a great partnership for them, not only in terms of incremental sales, while the contribution's still somewhat small, relatively speaking. I think in terms of just gaining new customers, which then come into Ulta itself, has been huge for them. I think it's really allowed them to expand their customer base.
I know you've been tracking some credit card data. When it comes to consumer spending on beauty, are you seeing any signs of weakness given the fact that there is so much uncertainty right now?
It's slowed, from the high double-digit rates we saw last year, which a lot of that was a COVID rebound. So, we're not expecting it to continue to grow, 15, 18, 20% in the prestige category this year, but we think it can still be easily strong high single digits, if not low double digits. So there has been somewhat of a slowdown, but still very strong versus what we saw pre-COVID. So I think that strength will continue through the year.
1,355 stores with plans to go between 1,500 and 1,700. Where are they opening those stores? Are those in malls or are those standalone stores?
Well, I think Ulta's, one of their differentiators and really I think has benefited them is the fact that they've been mainly off mall. Unlike Sephora, which, has also done really well, but they're, more in malls. And I think also, that's been an issue with the department stores too, being in malls where we've just seen less traffic. Consumers want more convenience. They want to be able to pop in the store quickly, pick up what they need. They don't want to have to walk through, large department store and through the entire mall just to get to one store that they're looking for. So I think that's been a huge benefit to them as they've, seen these share gains over the last several years.
Susan, supply chain issues, is that at all still a challenge here for the company? And also when we talk about inflation, how much have we seen some of these prices increase across the category?
Yeah, so, we're definitely seeing supply chain issues die down and inflation in certain areas. Transportation has come down quite a bit. Last year it was at historical highs. That's almost come back down to where it was. We've also seen commodity costs come down quite a bit. The one thing that has remained sticky and still up there is labor. So that's still going to be a pressure point for them this year. But the other areas, I think it could be a tailwind for their margins for this year.
We don't primarily think of Ulta as a services category, but their CEO just talked about that again with Brian Sazzi. How significant is that now, and could it be down the road?
Yeah, so the salons and their stores, that's still a small part of their business. It takes up, I want to say, 10% of the square footage in the stores, but it's still single-digit percent of sales. So I think it's definitely a growth opportunity for them and a way for them to convert not only just services, but product sales during those service visits. So I think it's definitely an opportunity for them to increase the sales there.
And Susan, going back to what you started with here, one of the main reasons why you're bullish is given the fact that their loyalty program has become so popular, just around 40 million members right now. Is there really significant upside just in terms of the growth trajectory of that number, given the fact that it is so large?
Yeah, it's definitely one of the largest programs out there, particularly, not including the mass retailers. Like a Target has over 100 million, customers in their loyalty program. The next largest is probably Ulta. So it's definitely very large, but there's over 100 million adult women in the US. So we think there's still opportunity for them to grow that loyalty program. And then on top of that, you have the Gen Zers coming up to age and, they'll become part of that loyalty program. I think one of Ulta's key strengths is the fact that they cater so well to this younger consumer. And so I think as those younger consumers grow up, there's just more opportunity to add to that program.
All right, Susan Anderson, thanks so much for joining us. Well, coming up, Lululemon shares are jumping in after hours, up just around 8.5% now, but is far from the only company that investors are watching. We'll show you what other names are making big moves next. Generative AI could impact some 300 million jobs around the world. That's according to a new report from Goldman Sachs. Now, adding that to 2/3 of jobs could be automated to at least some degree. Let's talk about all this, what it means for the manufacturing sector. For that, we have Jay Timmons, CEO of the National Association of Manufacturers. Jay, it's great to see you again. So let's talk about AI. How big of an impact do you see it being on the sector going forward?
I actually think it's going to be an incredibly positive impact on the sector because it is going to enhance manufacturing capability and output, and it's going to be a supplement to jobs all across the world. So, you think about all the technological advances we've had over the course of the last few decades, but especially the last 5 to 10 years, all of these advances have given additional capabilities to the workers who we have. And in fact, we've expanded the number of manufacturing workers in this country by over 1 million in the last few years.
So can it be additive when you look at GDP growth moving forward?
I think absolutely that it's additive. I'm actually in Europe right now. We are talking to several of our member companies who have operations in Europe, and they're very excited about the possibility of AI and other technological advances to help them increase production and capabilities in their factories. And they're also pairing that technology with the human factor. You have to have that in order to be successful. So I realize the jobs will change, but I don't think we're going to be eliminating jobs because of technology. I actually think we'll be adding jobs, adding human jobs to go alongside of robotics and other types of technology, including AI.
It's good news for many of the people out there that have been worried about AI's impact on the employment picture here going forward. Jay, I also want to talk to you about the stress that we've seen in the banking sector. Lots of talk about what that could potentially mean in terms of slowing economic growth. What are you hearing from your members?
Yeah, so this is actually very timely, Shauna, because as I said, I am in Europe. We are here, and I think the banking crisis that we've seen over the past few weeks really highlights one of the reasons that we're here. It is all about protecting and promoting democracy and doing that through commerce and strong relationships with our allies. The world right now is obviously in crisis thanks to Russia's invasion of Ukraine. They've made themselves pariahs. And so what we want to do is we want to make sure that our allies are being able to work together to solve some of these big macroeconomic issues, whether it's a banking crisis or whether it's increasing trade opportunities, which is the main purpose of my travels here in Europe, is to try to make sure that we're taking advantage of every opportunity to strengthen our relationships. I was in London today to talk about a potential US-UK trade agreement. I'm in the EU this evening to talk about the same. And I think that the most important thing that we can do as a business community in the United States is to reach out to our allies to make sure that those bonds are strong. We can overcome any obstacle, even a banking crisis, if we're working together.
And Jay, that's also the focus of the National Association of Manufacturers' latest survey. And you say in that report, policymakers must act with urgency. What do you need from policymakers, and what are you hearing from your members on that front?
So the first thing we need is a much more robust agenda from the administration. We haven't seen a trade deal negotiated in our country or with our country for 4 presidencies. And we haven't actually taken action on any trade agreement in at least 10 years, except for renewing the USMCA, which was really a modification of the trade agreement that was already in effect. Meanwhile, countries all across the world are making deals of their own. And what they're doing is they're taking business away from manufacturers in the United States. We're growing manufacturing in the United States thanks to the 2017 tax reforms, thanks to the infrastructure investment legislation, thanks to the CHIPS and Science Act. And we're hearing now more opportunities as a result of the IRA. But we can produce all the goods that manufacturers can handle in the United States, but our own market is only so big. We want to sell to other customers all over the world. 95% of the world's customers live outside of the United States. And we can strengthen our supply chains, and we can also sell our products if we have the right trade agreements in place.
Jay, what is the current picture of our supply chains right now? Because we've heard from a number of companies, really across many of these industries, pointing to the fact that we have seen significant improvement. I think it's safe to say the worst may be behind us, at least for now. But how big of an issue are some of these backlogs that we are seeing in supply chains today?
Yeah, I'm not going to jinx it by saying the worst is behind us, but I will, Sean, I will say that I've been hearing good news from manufacturers that our supply chain is unlocking. I I really want to make the point, though, that the supply chain, while we can supply so many of the inputs for our manufactured products in the United States, we still have to rely on product from other countries from time to time. We would like to make look, I represent manufacturers in the United States. I'd like us to make everything in our country. It's just not feasible. It's just not possible. Critical minerals, for one, we simply don't mine them in the supply that we need in the United States. We need to rely on a supply from other countries. That's why we need to solidify those trade relationships and those commercial relationships with our allies, because we've got some bad actors out there. We know we can't deal with Russia. We have concerns about China. We have concerns about India. So let's shore up our relationships with our North American allies, our European allies, Japan, Australia, so many others around the world, so that we can make sure that we don't have that meltdown again in the future, and we can keep our manufacturing base strong.
One other challenge addressed in the report, Jay, is nearly 3/4 of your members listed attracting and retaining quality workforce as a primary business challenge. How do we overcome that? How do you solve that?
Yeah, so, Dave, you just hit the nail on the head when I said we can't make everything in the United States. Even if we filled the 850,000 open manufacturing jobs that we have today, we still couldn't produce all the goods that are needed not only in the United States, but around the world. At the NAM, our Manufacturing Institute is engaged in many programs to try to attract, for instance, more women into the manufacturing workforce. We just simply have a huge gender gap in manufacturing. We're trying to work with the Second Chance Hiring Program, so those who may have been incarcerated for a nonviolent offense can come back and be productive members of the workforce. We have apprenticeship programs. We have programs on military bases. And then we have a program called Creators Wanted, which is designed to inspire that next generation of the manufacturing workforce and let them have an idea of what modern manufacturing is all alike, or is like, and let them see for themselves. And then that takes us full circle back to what you started this segment with. Young people are learning they're learning new skills when it comes to technology, robotics, artificial intelligence, augmented reality. All of those things are what modern manufacturing is all about. And that next generation are the ones that are going to deliver for us.
Indeed. Best of luck in that search. Jay Timmons, always appreciate you being here. All right, Shauna, what is moving after hours?
Dave, we got 4 names for you up here, and you can see lots of green here in extended trading. Lululemon, Micron, Calmain, and Dave & Buster's. Let's kick it off with Lululemon. You're looking at gains of just about 11% right now in extended trading. The company beating on both the top and bottom lines for its most recent quarter. Guidance was also very strong. Their Q1 revenue guidance and full year revenue guidance coming in better than what the street was looking for. Sales for the most recent quarter up about 30%. You're looking at Lululemon shares up just around 3.5% over the last 3 months. Over the last year, just in the red, off just about 3.5%, so not too bad given some of the volatility and given the underperformance of many of its competitors. Taking a look at Micron Technology, now that name up just about 1.6%. The big reason here, because the numbers were not impressive in this most recent earnings report, it's because maybe the worst of it is behind Micron. Let's get into some of these results here. They did report a wider than expected loss per share. Their revenue also fell short of expectations, was off 53%, over 0.5% on a year-over-year basis. Now, this chip maker, though, did have some encouraging commentary, the CEO there, just about inventories. He does see customer inventories improving, getting better, and does expect to see some gradual improvements to supply and demand balance here. So that was enough to push shares in positive territory. Over the last 3 months, you're looking at gains of just about 20%. Let's take a look at Calmain, the egg producer here, up just around 2% in extended trading. Egg prices have been soaring. Now, we've been talking about that now for quite some time. Just how much? Over 150% more year over year. Average for a dozen of eggs, $3.68. That's up from $1.46 a year ago. 12 months, that stock off just about 12%. Rounding it out now with Dave & Buster's. This stock up just around 2.5% in extended trading. The company reporting a record revenue, $563.8 million. Also announcing a new buyback plan, $100 million buyback plan over the last 3 months. Stock up just about 3% here over the last year. Very different story with shares off just about 16%, but record revenue here for Dave & Buster's. Pretty encouraging, Dave, when we talk about consumer spending, the fact that people are still going out, spending at restaurants, spending at experiences, one of the names that is benefiting, at least for now.
Who doesn't like the cloud game and
it.
some skee ball and all that action? All right, Shauna, thank you. Coming up, the potential sale of the Washington Commanders is heating up, and the bidding war reportedly reaches record territory. More details after the break.
A possible sale of the NFL's Washington Commanders is heating up. A pair of bids reportedly coming in at a whopping $6 billion. Needless to say, several billionaires are behind those reported bids. It's worth noting that one of the names you see here, Josh Harris, he already owns the NBA's Philadelphia 76ers and the NHL's New Jersey Devils. Now, this group also includes basketball legend Magic Johnson. If either of these bids is successful, it's going to easily break the previous record for a sale of a sports franchise. Denver Broncos were sold for just over $4.65 billion last year. Dave, lots of discussion about the timeline of the $6 billion, though. Two bids smashing that record.
It's remarkable when you consider Dan Snyder paid in the neighborhood of $800 million for this team back in 1999. Astronomical, the growth rate of professional sports franchises. And folks, it ain't stopping any time soon. The only thing keeping this one, quite frankly, at $6 billion is the fact that Jeff Bezos is reportedly not allowed to bid on the team, that Dan Snyder has told bank representatives at Bank of America that he cannot submit a bid. If you want to know why, well, he owns the Washington Post, which of course did some terrific reporting on Mr. Snyder and the scandal-plagued front office that he ran for years surrounding that organization. So you've got this Josh Harris-led group, and then the Canadian real estate billionaire Steve Apostolopoulos, who reportedly also bid $6 billion for this team. You got to figure this is the number that they can get beyond if they're going to have a bidding war between those two, somewhere up around $6.5 billion. Again, what can you say just about how eye-popping these numbers are? But when the Broncos paid that $4.65 billion, a then record, the thought process was that was way too much. That was overpaying by at least $1 billion. Here we are a year later, and it looks like they got a bargain when you consider how fast these teams are growing in value.
It's just amazing. And it's showing no signs of slowing down. We report time and time again just about some of these speculative bids, what could potentially happen in the sports realm when we talk about Manchester United, some of the interest there, how much that could potentially go for if it were to be sold. And then if the Cowboys were to ever be sold, there's talk about what that could go for $10 billion. I know they're saying that they won't go, but it just really speaks to the fact that these teams are so valuable, how quickly they have grown in value, and the fact that that trend to the upside remains intact. There's nothing slowing it.
The latest on Man U is that the bids did not get to the $7.4 billion threshold that the Glazer family wanted. They were somewhere between $5.5 and $6 billion.
A heck of a lot of money.
Chump change.
Yeah, exactly. All right. Well, it is closing time here at Yahoo Finance. Let's recap some of the biggest stories of the day. First up, banking regulators were grilled by the Senate Banking Committee about the failures of Silicon Valley and Signature banks. Among the things that we learned from the hearing was just how bad the run on Silicon Valley Bank was. Michael Barr, the vice chair for supervision at the Federal Reserve, telling lawmakers that SVB was expecting $100 billion worth of deposits to be withdrawn on the Friday that the bank was shut down by regulators.
Chinese tech giant Alibaba will be splitting into 6 separate individually run companies. The groups will be the domestic and international e-commerce businesses, the cloud business, the local services group, logistics group, and the entertainment group. Alibaba says the split will allow the company to be more nimble. Investors cheering the move, with shares closing 14% higher.
And finally, a big earnings beat for Lululemon, the retailer reporting earnings of $4.40 a share on revenue that was better than expected, $2.8 billion, both of which beating the street's expectations. Now, the company's guidance was also better than expected. However, inventories did increase by 50%, although not as high as what the street was bracing itself for. The results propelling the stock higher, up more than 10%. Look at that, 11% higher in extended trading.
Remarkable. I love closing time. That'll do it for Yahoo Finance Live today. Be sure to come back tomorrow, 3 p.m. Eastern, for all your coverage leading up to and after the closing bell.